Welcome, everyone. Thank you for joining us today. My name is Samantha Harris, and I am the Director of Programs with H.I.R.E. We are the hub for integration, reentry, and employment. We provide resources, mentorship, employment assistance, an array of other services for system-involved individuals. We also offer a reentry support group on Tuesdays. For more information about H.I.R.E, our services, or even our reentry support group, please go to our website at www.hireoc.org. We want to welcome you today to one of our financial literacy workshops. We do provide these workshops monthly. Our next meeting will be on Wednesday, March 19th. We do record these meetings, so you can also refer back to them, rewatch them as needed, and you can also find them on our website. Please feel free to ask questions. You can, type them in the chat. We do want this to be interactive, so please, participate at whatever level you are comfortable. But with all that, I would like to turn it over to Daniel Rodriguez with BMO.
Thank you, Samantha. So good afternoon, everyone. My name is Daniel Rodriguez. I am with BMO Bank. If you're not familiar who we are, we actually acquired Bank of the West, which is a regional bank in California, and now we've expanded our footprint to 36 states. So we're excited to continue the great work with H.I.R.E and supporting you all with these financial workshops. So with that, I will share my screen. Okay, perfect. So today we're going to be discussing the different types of banking services that are available to you to help you decide what services you might consider using. Have you ever thought about starting a savings account, getting a debit card, helping your children open their first bank account? Perhaps you're interested in opening a checking account to pay bills only online. If so, you probably know that to meet your goals, you will need to work with a financial institution, such as a bank or a credit union. This workshop will provide you with an overview of the types of banking service financial institutions provide and help you begin to think about which services make sense for you. So in today's workshop, we will learn, number one, how to identify different financial institutions. Two, how to compare different types of bank accounts and choose the one that is right for you. Three, ways financial institutions protect and insure your money. And finally, strategies to help protect your money when using online banking. Now, on the next slide, I'd like to go over a quick poll question here. So if you wouldn't mind answering A, B, C, or D, for what types of services do you need most from a financial institution? And if it's more than one, feel free to put that in the chat for us. Awesome. I see. Okay, so I see A, B, savings and checking accounts, and then I see for all types of accounts, right? So this is a great example. So you may have a variety of services you need from a financial institution, and that's okay. So today we're kind of going to go over the major ones, and we'll help explore the best way to meet your goals in the workshop. Our next poll question is, where do you currently bank today? Is it at a bank or financial institution, B, a credit union, or C, other? Most of the responses are for banks, and I do see one for credit union here. So again, there are many places you can do your banking. So we will cover these different places that you can do your banking to best meet your individual needs. If you've never used a financial institution to manage your money before or would like to use your current financial institution more effectively, you're not alone. Today, we will learn about how financial institutions and the resources they offer may help you manage, save, and protect your money. The decisions you make about how to save, convert checks into cash, or conduct other financial activities may be driven by your current needs as well as your future financial goals. A question to consider as you think about meeting your goals is, what do I need today to get to where I want to be? Financial institutions such as banks and credit unions are excellent resources when thinking about the best ways to save or work with money. Let's start by learning about some types of financial institutions. So where are some places people can go to cash their checks? As you can see on here, when I was referring to others, they are known as non-banking financial institutions, or more commonly known as money service businesses, such as check cashing services, which are businesses that transmit or convert money. Our traditional banks, right, like Chase, Wells Fargo, Bank of America, BMO, etc., are for-profit financial institutions that are federally licensed to receive deposits and issue loans. And then finally, credit unions. Credit unions are not-for-profit financial institutions that are member-owned and operated. And we'll talk a little bit more into detail about each one of these. So some of the services that has advantages for banks and credit unions over money service businesses like check cashers is that banks and credit unions provide many services that these check cashing places don't, such as offering checking and savings accounts. In addition to that, lower fees. Banks and credit unions might also be less expensive alternative to check cashing, as they may charge lower fees per transaction. Another great benefit of having a bank or credit union is that they provide insurance on your deposits. And finally, they offer interest as well. So banks and credit unions offer interest-bearing accounts, so the money you deposit into these accounts has a chance of increasing slowly over time. Now, it does sound like banks and credit unions are similar, but there is some differences between them. So let's take a closer look at each one, and then we'll compare them as well. So first, we have banks and credit unions. Both offer the similar items, right? As I mentioned, they accept cash, checks, wire transfer deposits. They provide loans, traveler's checks, foreign currency, and money orders. They offer many convenient services, including 24-hour online banking, physical ATMs, debit and credit cards, and many types of interest-bearing accounts. And most importantly, they offer insurance for your deposits on certain types of accounts of up to $250,000 per person. And we'll dig deeper into this as well. So now let's talk about the differences between these financial institutions. So first, let's look at banks. So banks are for-profit businesses that make money from account fees and interest from loans. They may have more convenient locations in the area or across the nation. They're open to everyone, and anyone can open an account with them. Credit unions are not for-profit businesses. So how they operate is they share their profits with their members, also known as customers, right? They may require membership in a community or a group to qualify. An example of this would be Navy Federal Credit Union. So in order to be part of a credit union, you have to either be yourself in the military or be a spouse, sibling, or any family member to be part of a credit union. A benefit to being in a credit union is they offer better interest rates and lower account fees. And they're typically smaller in size than banks with fewer locations. As you can see, so this is what we learned so far, right? Financial institutions are alternatives to using money services businesses, such as check cashing companies, or to keeping money at home. I know I'm guilty of that. I, store some money at the house, but it's better to take advantage of our banking system to be able to support you and have your money more secured. I know one of the biggest things, as I mentioned, everyone wants to protect the money they've worked so hard for. So one of the primary advantages of financial institutions is that they offer that insurance for your money that I mentioned earlier. So now how are banks insured? So financial institutions offer many ways to keep your cash safe, including deposit insurance and other security features. How does that work? Let's take a look. So money deposited into your accounts at banks and credit unions are insured up to $250,000 for each depositor. That means a joint account is insured up to $250,000 per co-owner. So as an example, if you have a bank account with a spouse or a partner of yours, now your relationship at that bank is protected up to $500,000. Now, it is unlikely event that a bank or credit union fails, but the Federal Deposit Insurance Corporation and the National Credit Union Administration make sure you don't lose your money. So keeping your cash at home, as I've done, even in a safe, does not provide this form of insurance against theft or natural calamities such as fires or floods, as we've seen in California, right? We were just devastated by the wildfires here, and folks potentially were keeping money in their homes. And it's unfortunate that some folks lost their homes and also lost their savings that they were keeping at home because they were afraid of putting their money into a bank. So now we'll talk about more about which accounts and products are protected through this insurance. So insurance covers the most common types of accounts, such as your checking accounts, your savings accounts, and your money market accounts. It also covers cashier's checks and money orders as well. Now let's talk about which type of accounts aren't protected. So insurance does not cover all products that you may buy from a federally insured bank or credit union, especially those related to stocks and bonds, securities, or life insurance products. Contents of a safety deposit box at a bank or credit union are not covered under this insurance as well. So keep that in mind. If you have a safety deposit box, we do know customers that instead of keeping their money in their home, they're utilizing a safety deposit box at the branch as well. And those funds are not insured also under the FDIC or the National Credit Union Association. All that to say, insurance can keep your money safe, but it is an interest offered through certain types of accounts that can help your money grow. And I'll talk a little bit more about that next. So how does your money grow at a bank or a credit union? When your money is in a financial institution, such as a bank or a credit union, it's going to earn some interest. But what exactly does interest mean? So interest is one of the most important concepts to understand when evaluating and planning your financial transactions. Interest is a fee paid to borrow money. It is collected by a lender and paid by the borrower. When you deposit money into a bank or a credit union, you are the lender and the bank is the borrower. That means the bank pays you the interest. However, when you take out a loan from a bank or credit union, the bank is the lender and you are the borrower who pays the interest. Interest is expressed as a percentage. I know that may get kind of tricky there, right? Because you're depositing funds into a bank, you are actually lending money to the bank for them to be able to allow other customers to borrow those funds. So just keep that in mind. That's the difference, right? There's going to be opportunities where you are the lender for the bank and the bank is the lender for you. That being said, interest is expressed as a percentage. Financial institutions offer a variety of products ranging from checking accounts to savings accounts to investment tools with different interest rates that may help your money grow. So again, when you deposit money into an interest-bearing account, a financial institution pays you interest to keep your money with it. In this case, as I mentioned earlier, you are the lender. You are lending your money to the financial institution, and the financial institution is the borrower. The higher the interest rate and the longer you leave your money in an account, the more your money will earn. So how does this interest help money grow? So now on the screen, you'll see here a simple graph. The bottom part of the bars represent the money you deposit into your accounts over time. The top part of the bar represents the interest you earn on your deposits. So as you can see, the amount of interest you earn is eventually greater than the amount you deposit, and this is referred to as compounding interest. So how does compounding interest works? So a simple example is, let's say you deposit $100. So here's where you start, into an account that earns 1% interest each year. In the first year, you earn $1 in interest on that $100 initial deposit. In the second year, you'll earn $1.01 in interest on the $101. In the third year, you'll earn $1.02 in interest on the $102.01, and so on. So you'll see that's what compounding interest means, right? You're collecting interest on top of your compounding deposit that you keep growing. Because you'll grow in interest on both your initial deposit and the interest, your money will grow more quickly over time. Now, switching gears, explaining owing interest, right? Similarly, when you take out a loan and carry a balance on credit cards, you pay interest to the financial institution. So, since interest is always growing, you will owe more than you originally borrowed. In this case, compound interest is working against you. When you use a credit card or take out a loan, the credit card company or financial institution is the lender, and now you are the borrower. Now, I know credit cards are an important tool, so they allow you to essentially borrow money for a short time in order to make purchases. Now, each month you have to pay the credit card company back. If you pay your full balance on time, you do not pay any interest. If you don't pay the full amount owed, you begin to owe interest as well. So essentially, you would flip this chart over to reflect the difference of borrowing money and depositing money. Now, with a loan, borrow money from a financial institution to pay for something, such as a house, a car, tuition, and of course, you have to pay back that original loan amount plus interest. Now, let's look at different types of bank accounts to see how interest may affect your banking goals. So here are the different types of accounts. So we will explore a few of these so you can become familiar with what are the available options. Don't worry if you're not ready or don't have enough money to open an account. A lot of banks now offer as a minimum of $25 to open a deposit account. This information will help you be informed and set a goal to open an account as part of your financial plan. Now, different accounts can be helpful for different needs. So we'll take a look at each account type and what it's best suited for. So we'll start with a checking account. So a checking account allows you to deposit and withdraw money for daily transactions. Checking accounts are designed for customers' regular use. Typically, they offer no interest or sometimes very low interest rates. A checking account typically also comes with a debit card or an ATM card. A debit card is similar to a check in that it withdraws money directly from your account when you make purchases at just about any store or online. While a debit card is a convenient feature, it is easy to lose track of your balance while you're spending, right? I know we all have Amazon, we shop using our debit card, so it's easy to lose track of your balance. And if you don't record your spending or regularly check your account, also keep in mind that debit cards do not contribute to building your credit. Other features of checking accounts are online bill payments, automatic transfers to your savings accounts that can help you stay on top of your responsibilities and make growing your savings account easier. However, it is important to learn about the consequences of misusing your debit card, including withdrawing more money than you have deposited, which may result in overdraft fees. Overdraft fees are often charged by banks and credit unions when your accounts are overdrawn. Now, for most financial institutions now, we have something that's called Overdraft Protection Act. So you can either opt in to this program or you can opt out, which helps you minimize receiving those overdraft fees. So make sure when you're talking to your bank, say, hey, I want to opt in to the program, or I don't want to opt into the program. And what this means is that you're only able to use the money that's available in your account. So you'll never run into overdraft fees. Now, if you're saving for a longer term goal and want to earn interest on your money, a checking account may not be what you need. That's for when we refer to savings account, right? So a typical savings account allows you to deposit and withdraw money, but the financial institution may require you to maintain a minimum balance. Savings accounts are useful for putting money aside for wants, emergencies, or a rainy day because they have higher interest rates than checking accounts. With a savings account, you take on the role of the lender and the financial institution becomes the borrower. In this situation, the financial institution pays you interest on the amount you keep with it. Now, here are some other accounts that are available as well. These are a little bit more specialized. So the first one here is what's called a money market account, or in short, referred to as an MMA. This is a type of savings account that often offers a higher interest rate than a standard savings or checking account. An advantage to having a money market account is you can write checks from it, but there may be additional restrictions like needing to keep a high minimum balance. Another type of specialized account is our certificates of deposit, or commonly referred to as a CD. So a certificate of deposit is a type of savings account that generally pays a higher interest rate than standard savings accounts because the financial institution holds your deposit for a fixed period of time, such as 3, 6, 9 months, year, or even up to 5 years. Federally insured credit unions do not offer CDs. However, they may offer share certificates. which earn dividends instead of interest. Unlike standard savings accounts, access to your money is limited, and you may be charged a penalty for withdrawing your money before the specified time. So make sure you keep that in mind. If you're going to open up a CD for 9 months and you run into an emergency, and let's say in the 6th month, and if you withdraw funds from a CD, there will be penalties involved with that. So keep that in mind when making a decision to set up a certificate of deposit account. Now, for those that have families as well, right? Is there a younger person in your life? Developing wise financial habits at an early age can help encourage responsible decision making and a healthy relationship with money before adulthood. Most banks and credit unions allow minors, which are people under 18 years old, to open accounts with a parent, guardian, or other adult. Here are a few account options. So joint ownership. So a joint ownership account is an account owned by the minor and their parent or guardian. Both the minor and the parent can make deposits and withdrawals. Sometimes the minor must receive authorization from their parents or guardian to make withdrawals. The other type of specialized account for minors is a custodial account. A custodial account, parents or guardians may open an account in the minor's name, but only the parent or guardian may withdraw money from this account. All transactions must be made for the minor's benefit. So either paying for tuition, paying for medical expenses, all associated with that minor. Now, how do you select an account that's right for you? So selecting an account type is an important task. Think about the following questions when deciding to open an account type. Who's the account for? What will you use it for? Is it for everyday transactions? Is it for long-term savings? If it's a savings account, do you want to be able to access it anytime? Or would you prefer it to grow untouched for a fixed period of time? Do you have enough money for a basic account, a money market account, a CD, or a share certificate? So all some great questions to think about when selecting an account that's right for you. Now that we have covered these types of financial institutions, interest, and types of accounts, let's apply our learning to a scenario. So in this scenario, Ali has been saving for his daughter's college fund. He has about $20,000 saved and has a goal to save $40,000 over time. So now, in this scenario, Ali has, as I mentioned, has about $20,000 that he's been saving for his daughter's college fund. He was keeping the money at home, but recently someone told him about safety deposit boxes at financial institutions. He was excited to learn that financial institutions keep your valuables in a vault. So he moved some important papers and his tuition savings into a safety deposit box at a nearby financial institutions. Based on what we've learned and talked about, what other options would work for Ali so that his money is protected? Awesome. Yeah, I do see some G's here. So all of these options work for Ali to protect his money. As you can see, I'll cover some more information based on the information. So, yep, savings accounts, keep his money safe, CDs, help him earn some more interest. All these are great options for him to consider instead of just putting his money from his home to a safe deposit box, which isn't insured as well. Out of curiosity, in any of those scenarios, who is the lender and who is the borrower? And how do you know? Hopefully, you guys were paying attention earlier. The correct response would be Ali is the lender and the bank is the borrower. Remember, as I mentioned, Ali's lending the money to the bank through his deposits, and in return, the bank will pay Ali interest on his deposits. So he's the lender to the bank because he's depositing those funds into the account. So now let's flip it. So let's see what happens if he owes interest. So we see Ali has saved 20,000, but he's still $20,000 short of his total goal of $40,000 for his daughter's college fund. Ali is considering taking out a loan for the remaining 20,000. His bank has offered him two options: a loan at 5% for 5 years, or a loan at 5% interest for 2 years. So if we look at the option 1 and option 2 there, what factor is affecting the differences in the total amount of interest in the example? So if we look at the examples here, right, in option A, it's a longer term. So the main difference between these two options is the length of time, because option A is for a longer length of time, the total amount of interest will be higher, even though they're both at the same interest rate. And in option B, the loan term is only for 2 years, so Ali would only pay $2,000 in interest. So he's saving $3,000 in interest by having that shorter term length. All right. Moving on here. So as you can see, oh, let me go back actually. So as you can see, interest can work in Ali's favor when he's earning interest on his savings, but it can add to his debt burden when he borrows the money, right? So there are other factors that could potentially make this process more complicated, such as compound interest, where interest is charged or earned on the principal and the interest itself over years or months. Be sure to double check with your bank or lender to determine how a particular interest rate is calculated. Great rule of thumb, be a responsible borrower. Only borrow what you can afford to pay back. And then remember, borrowing sensibly and making all your repayments on time can also help build your credit. So if you can only pay your minimum payment on any given month, maybe there was an emergency, please at least pay your minimum payment. So that way it doesn't affect your credit and you continue to build a strong credit for when you're ready to buy a home or a car. Take that onto account as well. All right. So far, we've learned about the benefits of banks and credit unions, namely insurance and interest. New knowledge about account types and requirements can help you be wiser about the financial decisions you make. So the next step is to visit your chosen financial institution, apply for a checking, savings, or money market account to start securing your money and earning interest. So now, knowing all that information, narrow it down to what's important to you. And then here's the information that you need to gather, some documents to open an account. So step 1, visit a bank or credit union in person or online to open a new account. Step 2, bring 2 forms of identification, which could be a driver's license, passport, birth certificate, social security card, or other form of government issued ID. Step 3, provide personal details such as your address, phone number, and email address. Confirm the accuracy of your name and address on any checks is a good rule of thumb as well. Step 4, have cash or a check with you to make your first deposit. There may be a minimum amount required, and typically right now for most financial institutions, that minimum requirement is $25 to get you started. For joint accounts or any type of account for a minor, provide personal information and identification for each person who will use the account. And then just as a side note, different financial institutions may have different requirements. So please make sure that you do your due diligence and understand what those requirements are for each bank. Now that we have you all set up, how are you going to be using your new account? So here are just some common ways people use various accounts that they have. So using your checking account, but typically your checking account is for paying bills, purchasing items, and making deposits. Typical uses for savings accounts is tend to have minimum balance requirements, but you're earning interest, so they aren't built to operate like a checking account. Generally, you deposit money into these accounts to save up for a longer term. Now, there's a couple of different ways to deposit checks into your new checking account. You can give the check to a teller inside the branch. You can use your debit card at an ATM to deposit your check. You can take a photo of the front and back of the check with your mobile device and deposit it virtually through your bank's app, which is a feature available with most financial institutions today. The other thing I'll touch on for checking accounts is how to use direct deposit. Many people set up direct deposit with their employer so that their paychecks automatically deposited into their account. To withdraw money, again, similar to depositing, right? Visit a teller inside a branch, use your debit card at an ATM, or use your debit card at store and online purchases. Sorry about that. And then to pay something, again, right, now you have different ways to pay for items. Withdraw cash, use a debit card, write a check, or set up auto payments. This is more solely used for when you set up your automatic payments for like your cell phone bill, your water bill, your gas bill. Definitely important tools you can use when setting up auto pay out of your checking account. So now we'll talk about a little bit about understanding what online banking is and then learn about how to help protect your accounts. So anytime you access your account at a financial institution using the internet, whether it's through a computer, laptop, tablet, or phone, you're using online banking. Most financial institutions have online component or a mobile app to make banking services available without the need to visit a branch, location, or an ATM. You can use many of the regular services online, including viewing balances, making deposits, and transferring money between your accounts. Now, here's a few things to consider when accessing your online banking. So, passwords. Use strong passwords, a mix of numbers, letters, and symbols. And I know now with the iPhone, it can automatically create strong passwords for you. So that's a great benefit of our technology, right? And keep it a secret. Another thing, a rule of thumb, do not use your birthday, birth name, or other personal identification information. These are the information that a lot of these scams are utilizing now, right? Targeting the most easy information to obtain to be able to hack those passwords. If you use a banking app on your phone, use a different password for your banking app and be sure to keep your phone locked and password protected. If you're going to be using a public computer, use a secure internet connection. Websites using the secure sockets layer encryption always show a web address with S at the end of HTTP. Look for web addresses that start with HTTPS semicolon slash slash instead of HTTP semicolon slash slash to ensure that you're on a secured site. You visit your local libraries, they all have this secure encryption attached to it. So you feel comfortable accessing your online banking there. Next piece, personal information. Never provide personal information to someone via email or phone. If someone claims to work for your financial institution, contact your bank directly to be sure. We have been seeing an uptick in the community for senior citizens where they get receiving emails. It looks like an official email from their bank, and it's asking them, hey, did we see a fraudulent transaction? Can you provide personal information? Your bank would never ask for your personal information because we already have it on file. So just keep that in mind when utilizing online banking. And then finally, logging out. Make sure you log out of all financial institution websites after accessing your accounts on those public computers. So I know online banking is a convenient and easy. However, safety is an important part of keeping your money secure. Now we'll talk a little bit more about some more safety and security scenarios. So what can the following people do to improve the safety and security of their financial information? So I'll run through some scenarios here. So George is very disorganized. To make things easy for himself, he uses the same password for all his accounts and devices. What could George do to be safe online? I'll give you an example here. So George could develop a system to keep track of passwords so he doesn't use the same one for every account. The solution could be either utilizing his phone to save all his passwords and using that strong password option, or having all his passwords saved in a secured place that he only has access to in case he needs to reference that. George could also use a password manager to keep track of his passwords. And all those services are now readily available on every smart device. So if you actually go to your Android device, your Apple device, or your any other device, it actually gives you that opportunity to have a password manager attached to it. Second scenario, Amira creates account security questions using personally identifiable information, like the street she grew up on, the place of her birth, and her birth name. What could Amira do to be safe online? this case, Amira could increase her account security measures by using fake but memorable information, such as names from her favorite book or movie. There's no need to reveal personally identifiable information online for password security questions. Just be sure to make note of your answers and keep them in a safe and secure place. I know we've all seen those when you create a password where it says, what was the first job you had? What was the model of your first car? Right? So in this scenario, Amir is going to be using fake answers, but memorable ones, right? So for example, my first car was a Volkswagen Jetta, but when I submit the information for these password questions, I'm not going to put that my first car was a Jetta. I may say it was a Toyota Corolla because I maybe remember that from a specific movie. Third scenario here, Ming loves the convenience of mobile banking, and she often checks her account when she is at a cafe or a restaurant. So what could you do to be safe online? I guess the biggest thing here is, hey, she might be using an unsecured network that can allow hackers to access and steal sensitive information. So in order to protect yourself, do not use public Wi-Fi. To protect your accounts, it is best to use a SSL secure website or Wi-Fi network that requires a password. So if Ming goes to a restaurant and the restaurant's offering Wi-Fi, just make sure that it's password protected and that they're providing that for her. Last scenario, Sam doesn't have a computer, so he does his online banking at a public library. So what can Sam do to protect himself? Be extra careful in protecting his data when using that public computer. So as Sam is taking advantage of online banking through his library, he needs to be extra vigilant to make sure he logs off from any accounts and does not use any autofill features when using a public computer. Online safety is an important part of keeping your money secure. Just as many financial institutions offer insurance to protect your money, you also play a role in ensuring your privacy and security. And so today, in summary, this class is about banking basics, and it just provided a solid foundation for learning new terms, tools, knowledge, and habits for building a healthy financial future. So just to recap, today we learned on how to identify types of bank accounts, how to compare different types of bank accounts to choose the one that's right for you, ways financial institutions protect and insure your money, strategies to help protect your money when using online banking. And in closing, I'll say, as with any plan, project, or lifestyle change, you will need time, energy, effort, and patience. Sometimes it is hard to get started, discouraging you due to come face to face with your financial reality, or difficulty to stay motivated. Being informed is key to success. The more knowledge you build, the sounder choices you will be able to make to improve your financial situation. Thank you so much, everyone, for your time. And that concludes today's workshop.